Thank you, Carrie. I'm Rick Miller, founder and CEO of Sensible Financial, a fee-only financial advisor. If you'd like to learn more about Sensible Financial, please check out our website, www.sensibleFinancial.com. As Carrie said, if you have questions, please enter them into the chat window. Thank you for joining us, and let's begin. This is the third of 4 webinars on retirement readiness. In the first, we looked at saving for retirement and when you can retire. Last week, we talked about your number, how much you need in assets to be ready. This week, we'll discuss the impact of Social Security benefits on your retirement plan. Finally, at the beginning of December, tracking your progress. We'll send reminders and links for the last webinar if you haven't registered already. And here are the key takeaways from the series. In the first webinar, we said that financial activity to date implies a retirement plan, and changing that retirement plan requires conscious action. Last week, we talked about how asset accumulation and post-retirement income influence your retirement readiness and how to calculate the income and assets you need. This week, we'll talk about Social Security, guaranteed lifetime income. It's a very important resource, and maximizing it makes a major contribution to your retirement. And finally, if you live longer, you need more resources, or you'll have to spend less. Let's get to today's topic, thinking about when to take Social Security retirement benefits. So let's get reacquainted to start with the Y'alls, our imaginary client couple. Their earnings and earnings history are at fixed percentages of the Social Security wage base. And that wage base is the maximum earnings on which FICA taxes are paid. That number for 2020 is $137,700. They've accumulated about $450,000 in assets so far, and their spending on discretionary items is about as much as they can afford, about $38,000 a year. And they have to pay rent. They rent at $30,000 a year, and they have to pay taxes. We're not showing those, but they pay them anyway. Otherwise, they wouldn't be so happy looking. They would be behind bars. And they're planning to live to 100. We'll talk more about why that's important next week. And at this point, they plan to start Social Security benefits at 70. And let's also recall our economic assumptions. This is the world the Y'alls live in, and it looks very much like the world we live in. Taxes and Social Security are the same as the ones that you experience, or the systems are the same. We've had to make assumptions about what Social Security benefits will look like and Social Security taxes will look like after the system becomes insolvent, which is projected to do in 2035. And we've assumed that Congress will split the difference between benefit reduction and tax increases. And you also see the interest rate and inflation assumptions that we've made. So the question for this week is, when should they start Social Security? In general, people tend to know that their Social Security start date is a really important decision, and many people think about it a lot. And a lot of the time, the people who are thinking about it and their accountants tend to use investment analysis to decide when to start. Today, I'm going to argue that this is an incorrect approach. I suggest that Social Security is a kind of insurance, and thinking about it that way produces a better answer and a more secure retirement. Why does it matter when you start Social Security? If you've looked at your Social Security report, you've seen that the benefits vary on when you start. And you'll notice that we've highlighted here the age 67. You can start your Social Security benefits anytime between 62 and 70. And we've highlighted 67 because it is the full retirement age for the Y'alls. Full retirement age varies a little bit depending upon your birthday, but we're not going to get into that today. That's easy enough for you to find out. Just go to the Social Security website, look on My Social Security, and it will tell you how to determine what your full retirement age is. Social Security tells you that if you take benefits before full retirement age, the benefits are lower. There's a penalty. And if you take benefits after full retirement age, you get more. You earn delayed retirement credits. That suggests that there's something special about the full retirement age. But if you look at it starting at age 62, you see that every year you wait from 62 until 70 yields a higher benefit. And that's the way I encourage people to think about it. Each year you wait from the date you can start gives you more. And the question is it enough more? In this case, we're going to ask for the y'alls, is it worth it to wait until 70? And we're going to focus on Tina. I'll go back just for a second here. You see that if Tina starts at 62, she gets $23,821 per year. And if she waits till 70, she gets $42,197. That gives her an additional benefit of $18,000 a year. But to get that, she has to wait 8 years. And the question is it worth it? If she waits those 8 years, she's giving up almost or over $190,000 in benefits. That is a lot. So it seems very difficult that it should be a good idea for her to wait that long. Let's look at the typical break-even analysis that people do. And we'll look at Tina's situation, and we'll think about the benefits that she would get if she starts at 62, and they're shown on the blue line here. And we're going to add them up. So the first year she's going to get $23,800. The next, if you add the $23,800 that she gets the next year, we're up to $47, and so forth. If she waits until 70, then she gets substantially more. But if you look at the benefits that she's cumulatively received by age 70, she's down here at $40,000 and up here at $200,000. So at this point, if she were to have died at 70, she would have gotten a lot more benefits by starting early than by waiting until 70. And for each year that she lives through, we can see the advantage to starting at 62 rather than at 70. You notice that advantage gets smaller, and that if she gets to age 80, there is no advantage anymore. The cumulative benefits are the same at age 80, whether she started at 62 or at 70. And if she lives longer, the advantage then shifts to starting later. And the advantage gets even larger the longer she lives. Now, so if we think about the conclusion that Tina comes to here, it is if she expects to live past 80, then she should wait. If she doesn't think she's going to live to 80, then she should start early. So suppose Tina says that she expects to live to age 82. Then she should wait until 70 to start. Now, suppose that at 67, she decides to check. So now she can't go back and start at 62. She has to start at 67. She can do the same kind of analysis, and she can compare the advantage that she has at starting at 67 versus the amount that she gets at 70. And so she can compare them. And this time she learns that if she expects to live to 83, that it's better to start at 70. Otherwise, she should start at 67. Well, how do we interpret that? Should she, since she thinks she's only going to live to 82, should she start now? But that's different than what she thought when she did the analysis at 62. So which is it? Should she start at 70 if she expects to live to 80, to 83? And it gets even more confusing than that, because if she does that break-even analysis again at 68, the break-even age will be higher than 83. So for which age should she do the analysis? It's hard to do the work this way or to think about it this way, because deciding how long you'll live is not easy. And the answer changes depending on when you do the analysis. Now, I'm going to suggest that these aren't just difficult questions. These are really the wrong questions. So let's think about this a little bit more. Social Security is special. The Social Security benefits that you receive last as long as you live. They're contingent on your lifespan. And because of that, that special nature, maybe a different approach is appropriate. So let's think about other kinds of contingent resources. Insurance payments are contingent. And each of the types of insurance that we're showing here pays out only if a specified event occurs in your life. A death, an illness, an accident, property damage. Investments are different. Investments pay off whether or not you have an incident in your life. They're independent of your personal experiences. And for that reason, we would say, or I would say, that Social Security is not an investment, it's insurance. And if you think about insurance, you think about insurance differently than you think about investments. You don't do break-even analysis on your car insurance, let's say. You consider the major losses that might occur, and you decide whether having extra resources in those unlucky circumstances would be worth the premium. So your homeowner's insurance premium is far less than the settlement that you might get if your house burned down. And you decide that you're willing to pay that premium because you really don't want to have your house burned down and not have the insurance company pay to have the house replaced. And even though we don't usually think about long life as unfortunate, if you live a long time, you need more resources, maybe a lot more resources. So from that perspective, it is something that you might like to buy insurance against. And Social Security is that kind of insurance. And I believe, and I encourage clients to believe, that it's wise to plan for a long life, because if you plan for a shorter life and you're surprised on the upside in terms of lifespan, then you have to figure out where you're going to get the extra resources. If you plan for a long time, a long life, then if you live a long time, even if you might be surprised, the resources are there. Now, let's think about what impact waiting to take Social Security benefits or not waiting to take Social Security benefits might have. Remember, last week we figured out that the Y'alls would need more assets to retire earlier at their current living standard. If they retired at 65, they needed $820,000 to retire and maintain their living standard of $38,000 a year. If they retired at 60, they needed $1,134,000. And if they retired even earlier, then they required even more. In all of these scenarios, we're assuming that they're going to take their benefits at 70. And let's look a little bit more closely at the retire at 60 scenario, where they need $1,134,000 in assets in order to retire. This is their lifetime balance sheet at age 60, retiring at age 60, and planning to claim benefits at 70. So if they plan to claim their benefits at 70, and we look at the assets that they have, there are no future earnings because they're retired. Their Social Security benefits are worth almost $1,600,000. They have $286,000 in retirement accounts. They have $848,000 in taxable assets. Those two together add up to the $1,134,000 that they need in assets. In total, those assets are $2.7 million. And looking forward, they'll spend $40,000 in taxes, $1 million in housing, $250,000 on Medicare Part B, $1,350,000 on discretionary spending at $38,000 a year, and $23,000 on other expenses. And that total is the same as the total of their assets. That's what we mean by sustainable living standard, or the amount of spending that they can afford to do. That $38,000 a year adds up to the $1,350,000 that just exhausts, when you add all these other expenses, just exhausts those total assets. Suppose now that instead of drawing at 70, they change their minds and they decide that they're going to draw at 62. What does the lifetime balance sheet look like now, or in that event? Their Social Security benefits now are worth $1,194,000. That's about $380,000 less than if they take the benefits at 70. Retirement accounts are worth a little bit more because when they made their decision at 55 to take their benefits at 62, they realized that they would have to spend only $29,000 a year, not $38,000, and therefore they've been saving a little bit more. Housing costs the same, taxes are a little different, Medicare B is just a tiny bit different, but their discretionary spending is substantially lower. And it's lower because the Social Security benefits are lower. Their total assets are $2.4 million versus 2.7 and some, 2.7 and change. So if they claim at 62, they give up $380,000 in Social Security benefits. And if they wanted to spend $38,000 instead of $29,000 a year, they'd have to come up with that $380,000 someplace else. So, as the title of the chart suggests, claiming early is really expensive. It costs them a lot of benefits. It's almost 25% of the value of their benefits they give up by claiming at 62 instead of at 70. Now, what about Social Security benefit reductions? We've assumed that benefits will be reduced by about 11%. Suppose that you don't agree with that. Suppose that you believe that Congress will fix it so that benefits are unchanged. Can you change your retirement date at all? Well, if you assume that the benefits will be higher, then the lifetime value of those benefits will also be higher. If we think about the Yalls have $1.54 million in Social Security benefits, assuming the reductions that we assumed. Without those reductions, at age 60, those retirement benefits would be worth $1.73 million. And retiring at 60, they'd be able to spend $43,000 instead of 38. So if they a slight apology is due here. I have done this not retiring at 60, but at 65. And we're seeing the change in retirement date that they would get from 65 if they get full benefits. So they'd be able to retire at 38,000, retiring at 65 with this much savings and this much in Social Security benefits. If they get full benefits, if the benefits are not reduced, then they'd have about $200,000 more. And so retiring at 65, they'd be able to spend $5,000 a year more, or retiring at 63, they'd be able to spend about the same. So assuming that the benefits will be higher, assuming that the benefits will be what Social Security is promising you now, then they'd be able to retire about 2 years earlier. Now, we're financial advisors, not political scientists. We can't tell you what's really going to happen with Social Security, and probably even a political scientist can't tell you that. But we recommend relying on having Social Security benefits, but we do believe that benefits will be reduced, and we think it's a good idea to assume that they'll be reduced a bit. And that is the conclusion of the prepared material, and we can take questions.
Okay, great. Jose asks, Does your analysis change if Social Security benefits get cut 11% to keep the Social Security fund solvent, as you've guesstimated?
So the analysis does assume that they are cut 11% already. So, sorry, if we go back here to look at the benefits, these are these benefits already assume that the reduction of 11% will occur. So in this case, and in general, we factor that in. We factor the reduction in, and then when we got to the slide at the end, the very last slide, we showed the impact of assuming that the benefits would not be reduced. That would allow you to retire a little bit earlier. So assuming that the benefits will be reduced, as we do, then causes people to want to retire a little bit later or to have more in other assets in order to be able to retire.
Okay. Another question. Does the lifetime balance sheet take into account age or how long they will live?
Very good question. Let's go and look at one. This lifetime balance sheet is calculated at age 60, and it assumes that the Yalls will live to be 100. We've added up their taxes until age 100, their housing expenses until age 100, Medicare Part B premiums until age 100, and so forth. And on the asset side, we've added up their Social Security benefits from age 70 to 100, their retirement accounts, and their taxable assets we can see now, right? Those are the assets at age 60. But all the rest of this is based on forecasts. And if we changed the final age from 100, let's say to 99, all the numbers would be a little smaller. And if we change them from 100 to 101, they'd all be a little bit larger.
Okay. Maggie asks, for a couple, does it make sense for the man who has an inherently lower life expectancy because of family history, gender, to take Social Security earlier than the woman? Both have worked full-time for 30 plus years.
I would say that while the life expectancy in general is lower for men than for women, almost always when we do this analysis, we find that it makes sense for both members of the couple to wait until 70. Not always, almost always. And each situation is different. And it's wise to not rely on either rules of thumb or what some financial advisor tells you in a webinar. You should do the analysis or have the analysis done for your specific personal situation. In general, the point that I'm making here is simply that the standard break-even analysis that I showed you first is probably not the most informative or helpful analysis to do, and that thinking about it from a lifetime balance sheet perspective is much more helpful. And there is very good software available to help think this through. I believe that there's a piece of software called Maximize My Social Security Benefits, which is a very good piece of software. And there are others. I'm sure that if you look for Social Security software on the internet, you'll find either that one, which I would recommend, or there are others.
Okay. Someone asked this question: what is the likelihood that Social Security will become needs-based versus cutting benefits for everyone by 11%?
That is a very interesting question. Again, not a political scientist. I would say, first of all, that there's a sense in which Social Security benefits already are needs-based. the percentage, the replacement percentage, or if you took the Social Security benefits and divided them by lifetime earnings, and I wrote a Forbes article, and perhaps we can append the link to that article to the webinar that talks a little bit about how primary insurance amount is calculated. But that replacement ratio is higher for people with lower earnings than it is for people with higher earnings. So there is already a needs-based component to the calculation method. To the extent that the analysis becomes, or the benefit calculations become more needs-based, then conceivably that could change the conclusions that we would draw from this kind of analysis, depending upon where in the income distribution the person or couple or family is. You could certainly change the assumptions and see how that would change the analysis.
Okay. Ray asks, does subchapter SK1 distributed income count as income that would offset Social Security benefits if taken before the full retirement age?
I do not believe so, but if the person who asked the question will send their email, put their email in the Q&A, then we will send them a specific answer.
Great. Okay, here's from Mitchell. My wife and I are the same age. Does your analysis change if she only gets spousal benefits? Although my benefit increases if I wait till 70, hers does not increase after 66. Okay, I'm not, sorry, I'm misreading this.
Well, but I think the question is, should both spouses wait till 70 if one is going to be taking spousal benefits? And again, I come back to the answer I gave to an earlier question. In general, I shouldn't even say in general, most of the time, or for many situations, it is wise for both spouses to wait until 70. But there are many situations in which that is not the case. And that's why it's important to do or have done a personalized analysis. There are Social Security as a system is almost unbelievably complicated. And so making off-the-cuff answers is to specific situations is extremely unwise because there are so many factors that come into play. So it's best to do an analysis and see when it makes sense for one spouse to take spousal benefits. When it makes sense for one spouse perhaps to start benefits before age 70. I guess that the best way to say this is I've constructed the YALs to be a reasonably typical couple, and in many cases it is wise to wait until 70. But we could easily construct couples and pairs of income streams that would change the recommendations and might change the recommendations substantially.
Sorry, I muted myself. Okay, for the y'alls, what is the Social Security future reduction percentage that makes the balance sheet equivalent to claiming at 70 versus claiming at 65? In other words, it's better to wait until 70 in the 11% reduction scenario, but what if it's reduced even more?
I see. I haven't done that exactly. It's going to depend on income, for one thing, because the replacement rate changes with income, right? So if I think that the situation that is most likely to cause you to want to draw earlier is your age 62 is, or your age 70 is 2035. So your age 62 is 2027. And so that's the first thing. And then secondly, there is a dramatic reduction in Social Security benefits for people in your income category. My suspicion is that it's got to be in excess of 30 or 40%, which frankly I don't think is likely, but anything is possible. But it has to be a very large reduction before it's, and it's a reduction that I would be loath to forecast. And I'm if we take a step back and we think about forecasting political outcomes and then forecasting the policy implications of those political outcomes, I'm reminded that just 4 weeks ago, I was pretty persuaded that we were going to have a so-called blue wave come out of the election, and that the Democrats would be comfortably in charge of the Senate, much more comfortably in charge of the House than they are now, and that therefore there were going to be dramatic changes to the tax system. And 4 weeks later, we see that that's not the case. And if we can be that wrong in 4 weeks, it's easy to see that we could be dramatically a lot wronger, if that's appropriate language, forecasting 15 years.
Okay. Jose asks, what's the main difference between Maxify and Maximize My Social Security software programs?
Maximize My Social Security software program focuses only on Social Security. Maxify incorporates Maximize My Social Security, or at least most of it, and it does sophisticated financial planning as well. So Maxify is a much more comprehensive piece of software than Maximize My Social Security is. Maximize My Social Security also provides more detailed reporting on Social Security benefits, and helps make decisions more explicitly than Maxify does. We use both, although we find frequently that the answers are, I guess I would say we find all the time that the answers are the same, but they're easier to, if you're thinking just about Social Security benefits and when to take Social Security, Maximize My Social Security provides much more, it's a much cleaner user interface, I guess I would say. It's easier to interpret the results focused on when should I start Social Security benefits than in Maxify. You can get to the same place in Maxify, but the Social Security decision is just a subset of the analysis that you can do in Maxify.
Great. We have just one more question. Actually, I have a question, but what kind of advisors help figure out these questions is what an attendee asks.
That is a really good question. I would say that, first of all, any certified financial planner should be able to provide that kind of support. Advisors who do financial planning and who present themselves or represent themselves as financial planners should do this kind of analysis. But any certified financial planner, and that's a CFP, which is a registered mark, any advisor who has that should be capable of doing that sort of analysis for you. And that's not to say that there aren't other advisors that can as well, but the CFP mark is granted to people who focus on financial planning for individuals.
Well, my question was, are there circumstances when it really doesn't pay to wait until 70? You mentioned that there might be.
Yes. So the most I guess I would say the most obvious circumstance is one in which one or both spouses know for a fact that they're not going to live to 100, and in fact know for a fact that their lifespan is likely to be shorter. That could be in a situation where people have an illness. It's most likely to be a circumstance where people have an illness where their physician has told them that their chances of living, let's say, into their 80s are small. Then the way to do that analysis is just to change the last year for which you're doing the plan. And if we go back to you can sort of see what's happening here if we look at this, right? If the cutoff point for the analysis were here, then it would be less likely that you would, especially if we moved if the cutoff point were 82, let's say, then we just saw that if we do the analysis for Tina at age 67, the break-even age is 83. In fact, the break-even age being 83 is the same as the age at which that if we plan to that age, we would shift from 67 in this case to 70, right? So if Tina knew that she was only going to live to 82, then all this time out here doesn't matter, and then we'd be taking benefits earlier. Does that answer your question?
It does. It does. I was wondering what the circumstance was. We do actually have another question from Anthony. How do we find a financial planner that doesn't just sell products, but works out the best overall plan for each client?
That is another good question. First of all, I can tell you that Sensible Financials is the only advisor, and we don't sell products. NAPFA members, so members of the National Association of Personal Financial Advisors, do not sell products. Advisors who hold themselves out as being fee-only advisors do not sell products. And you can find those on the website of the CFP board. I don't remember whether the Financial Planning Association website will distinguish between advisors that do and do not sell products. But the NAPFA website, NAPFA, has a tool to help you find advisors, and none of those advisors sell products.
Great. Well, thank you, Rick. This was really an edifying talk. And thank you for coming to today's presentation. Next week is the last of the 4 webinars in this series. It's called Am I on Track to Retire? Including the Impact of Life Expectancy. That will be December 1st, another Tuesday at 2 p.m., same as this one. And as I said before, you can go on the Sensible Financial website on the webinars page, financial planning webinars page, and see videos, the webinars that you've missed. If you missed the first or the second one, you can also register for the one next week. And thank you for coming.
Thank you.